What's up, everybody? Going to do an educational video here talking about the Ichimoku cloud. My channel is not focused on doing educational content on new types of indicators every week because that's not what I do. Real trader focused on using real indicators that I've come to know work to my advantage. So I really want to bring those to the forefront and teach them to you. The Ichimoku cloud is one of the best technical indicators that you can use in all of trading. But it seems daunting. You look at the Ichimoku cloud, you say this is way too confusing. It's one of the most complicated indicators. How can I use it? This video today should simplify it for you, and I'll show you how I incorporate it to my trading, and you might want to do that for yourself as well. Let's talk about the Ichimoku cloud. If you want to get into all the definitions and the history of it, you can go over to investorpedia.com, check out the Ichimoku cloud definition and uses, and you can get some good educational information there. We're going to talk about what they mean and how we use it in our everyday trading. So it's got 5 components. It's the conversion line, the baseline, the lagging span, and the lead 1 and the lead 2, which make up, the lead 1 and lead 2, they make up the actual cloud portion. When you just talk about the cloud without these moving averages, essentially, it's called the Kumo cloud. So if you're trading with the Ichimoku cloud, but you're not actually using the conversion base or lagging span, you are just using the Kumo cloud just for a technical definition standpoint. So let's go into each one and see what they mean. What do all these charts, all these lines on this chart mean, and how can we simplify it and use it to our advantage? First, we're going to talk about the conversion line. That's this blue line over here. Okay, so I've taken everything off the chart. We're only looking at the conversion line. The conversion line is telling you the 9-period high plus the 9-period low divided by 2. So essentially, we're looking for the midpoint of the last 9 trading days. So here I've already put in our measuring stick. If you're using, TradingView, that's the one we would be using here, and that is called the date and price range. That's the one I like to use. So reminder, we're using the last 9-period high and the 9-period low. So here's our 9-period high. Here's our 9-period low, but we got to go across 9 periods. So this candlestick to this candlestick is 9 periods. High to low, but we got to go across the whole 9 periods. Now, if you look at here, we got the midpoint. That's this arrow right over here, and that's where the blue line is. Okay, you see, if we just remove that now, you see that's where the blue line was, and that is the conversion line. So the conversion line is based off of the last 9 periods, the midpoint. This is minor short-term support and resistance. This could be compared to, the 8 exponential moving average, for example. You can see here, when you are trading below the conversion line, you're in a downtrend, you're in a bearish trend. When you bust above the conversion line, it signals you're in an uptrend and you're in a bullish trend. So that's one way you could use the conversion line. Hey, we're trading below, I want to be bearish. We're trading above, I want to be bullish. That's the conversion line, also known as the turning line. Let's move on and talk about the baseline, also known as the confirmation line. This is the 26-period high and low divided by 2, which is the midpoint. So we come over here. This is the 26 periods from this candlestick over to this candlestick. Reminder, periods, you could be on 5-minute candles, you could be on daily candles, you could be on weekly candles. It's essentially the last 26 candles when we talk about periods. So here is our high, here is our low, but we have to cross it all the way to the 26-period point, and that's where we find the baseline right here in the middle, and there you go. There's the red line. So there you have your baseline, and that's how it's calculated. This is considered medium support and resistance because this is a longer time frame. This is a 26-period time frame. We were talking about the conversion line, which was a 9-period time frame. So the longer the time frame, the more significant the support and resistance is going to be. Again, if you're trading above the baseline, you have medium momentum uptrend. So you expect a bullish trend to last a little bit longer because it's based off of the last 26 periods. Again, medium momentum downtrend when you're trading below it. You can also use this as a support and resistance level. You can see some rejections here. You can see some supports here, some supports here, some supports here. That's how you would use the baseline, also known as the conversion line. Let's move on. Talk about the Leggings Span. This is the one I do not like, and I wish they didn't incorporate this into the Ichimoku cloud, but there will be traders out there that live off of the Ichimoku cloud and that will argue differently. So let's talk about it. The Leggings Span, also known as the lagging line, is the close price 26 periods in the past. So you can see here, here's the price we closed at today, and there's where it's plotted, 26 periods in the past. So it's based off of previous price action. Okay, so now, how do you use this? Oh, and I'm trying to delete this, and it's not letting me delete it, but we don't need it. How do you use this? If the lagging span is below the price action, it indicates a bearish trend. If the lagging span is above the price action, it indicates a bullish trend. Well, you're 26 periods in the past. So how do you determine this? Well, let's go look at it over here. So let's use this candlestick, and we're going to see where the lagging span closed, because this is 26 periods in the past. So that's the candlestick right over here. So now what I want to do is look at that candle, look at where the lagging span would have been at this time. Okay, that's where it would have been at this time. Reminder, prices are here. We see this now because we've already printed. We don't see it here. But what this tells me is that when we closed over here, reminder, below indicates bearish. This lagging span was still trading below its price action. So this tells me, although we've had a nice move up over here, we still have a bearish bias and the price should return back into a downtrend. 26 periods in the past, a lot could change in 26 periods, so it's a little bit tricky. I don't love it. I don't like to use it. I don't use it personally, but it is something you should be aware of. And looking at it over here, in this case, you can see the price, the lagging span is just above the price, but we've been choppy in this range, which tells us we're likely going to stay in a choppy range until we get a clear movement like we saw over here. That's how you would use the lagging span. Let's move on and talk about now the Kumo cloud. This is my favorite tool. This is what I use. I don't use the conversion line. I don't use the baseline. I don't use the lagging span, but the Kumo cloud is a staple. This is dynamic support and resistance. Big time support and resistance. So the lead one, this is the first one we're going to talk about. It's the green of the cloud. It's the conversion line plus the baseline. So let's bring up the conversion line and the baseline so we can look at it together. Let's bring it up. Conversion line and baseline. Now, let's close this off and let's look at this. So it's the conversion line plus the baseline divided by 2 for the midpoint. The leading one forms one of the cloud boundaries plotted 26 periods in the future. It forms the top part of the green cloud and the bottom part of the red cloud. Okay, so reminder, we got the conversion line. Let's bring it up here. Let's get this in real detail. Okay, we've got the conversion line, which is the blue line, and we've got the baseline, which is the red line. We're looking for the midpoint 26 periods in the future. So what I've gone here is I've gone 26 periods in the future from where they are, right over here, and the midpoint is in the middle, right over here, and that's where the lead one develops, right there. Okay? You probably have to review that a couple of times, but essentially you got the conversion and the baseline. We're looking for the midpoint 26 periods in the future. Now, at the end of the day, you're not really going to need to know this whenever you're trading with the Kumo cloud or the Ichimoku cloud, but you do want to be able to say, hey, I kind of understand the definition and how these lines are calculated and why it's dynamic support. So at the end of the day, a few weeks from now, you might be using this. You're not going to be like, oh, I need to understand. Was it the 26 period or was it the... Don't make it so complicated. You get the point. So that's how we identify the lead one. Now we're looking to identify the lead two, which is going to be the red line. Okay, it's the red portion of the cloud. 52 period high and low divided by 2 for the midpoint plotted 26 periods in the future and forms the other cloud boundary. Forms the bottom part of the green cloud and the top part of the red cloud. Okay, so we got 52 periods. Okay, I've identified 52 periods here from this candlestick all the way to this candlestick. We're using the bottom and the top. That brings us to a midpoint right here. But now we need to go 26 periods in the future to identify this midpoint. So we're going to come over here. We're going to go 26 periods in the future. And we got there, right there. And that's where the red line is. And all of this now gives us the actual Kumo cloud. So when you look at this on TradingView, you would want the plot backgrounds to come up to the forefront, and then you have the cloud. So let's look at this here. This is the entire Ichimoku cloud. Now, I've made the green and red different colors here, purple and gray. You just choose whatever colors you want. If you like the green and red, use it. I like to keep it a little bit more subtle in the background. But let's talk about the trading strategies. And in this case, I am going to remove the lagging span because, again, I don't really like it. And, you know, I don't need the confirmation bias if it's a bullish bias or a bearish bias based on 26 periods in the future. But let's talk about some of the strategies you could use. When you use the conversion and baseline cross, this is strategy number 1. So it's a conversion baseline cross. It's a buy and sell signal, factors in the strength based on where the Kumo cloud is, strength or weakness on the cross. So what that means, let's sum it up. So you can see here, let's go over here. We have a conversion and baseline cross. Okay, so the conversion line crossed below the baseline. This is similar to using a moving average cross, an 8 exponential crossing the 12 exponential, or the 4 crossing the 8. People like to use exponential moving averages crosses or moving average crosses. This is the same thing with the Kumo cloud. You're using the conversion and the baseline as a cross. Now, when you see this cross happen, right, the blue line cross below the red line, that is a sell signal. This is a bearish sign. Now, factor in where the Kumo cloud is for its strength. So I'll give you an example of this over here. And I'm going to use this one right over here. Let's just zoom in a little bit on this one. So reminder where the cloud is. If the cloud is below price action, you're in a strong trend. You're in an uptrend. You're in exactly where you want to be in a bullish market. If the cloud is above the price action, then you're in a bearish trend. So when you get these crosses, you want to incorporate them with where the cloud is. For example, we had a bearish cross over here. The blue line crossed the red line down. But reminder, price action is above the cloud. So this is a very weak signal. Very weak signal in terms of a buy. Now over here, you could see we had let's go to a different example over here, where the blue line crossed the red line here, which is a bullish signal, and you're trading above the cloud. That is a very strong buy signal in terms of the Ichimoku cloud. Now let's look at it over here from a bearish standpoint, right? We have the conversion line crossing the baseline down, and we lost the Kumo cloud here. So this is a very strong sell signal. And as you can see, the price action ended up being significantly downward here. Now again, over here we had a conversion line cross the baseline, but we're still trading above the Kumo cloud, and it ended up holding. And then you had a bullish cross over here, and look at the price action, huge move to the upside. So when you factor in the conversion and baseline cross, you want to factor in where is the cloud. Are we above the cloud? If you are above the cloud and you get a bear cross, it's not really that strong of a signal. If you get a bear cross and you are below the cloud, very strong sell signal. Same thing for bullish. If you get a bull cross, but you're trading, here's a bull cross, but you're trading below the Kumo cloud, what happens? You get the bull cross and you get faked out, and then the stock continues on its downtrend. So when you use the crosses, don't lose sight of where the cloud is. If the cloud is below price action, bullish. If the cloud is above price action, bearish. Okay, another strategy we're going to talk about here, and I'm going to remove the conversion and baseline now. And this is essentially how I personally use the Kumo cloud for my trading strategy. I don't use the conversion and baseline crosses because I like to incorporate Bollinger Bands instead. I like to incorporate the 8 exponential moving average instead, and I can follow price price action based off of volume and trend very well. So I don't need the conversion and baseline to tell me what I should be expecting in price action. Not to discredit it, it is a very good technical item to use for your entries and exits. However, I don't use it. I trade this way, off of the Kumo cloud. When you get a Kumo cloud breakout, okay, when you get a Kumo cloud breakout is a significant shift in the price. It's in the price action. You've been in a downtrend, you get a breakout of the Kumo cloud, you should start to see the uptrend develop now. Again, if you break the Kumo cloud down, you were previously in an uptrend, you break the Kumo cloud down, you should see a significant downtrend. Being above the Kumo cloud or below the Kumo cloud is essential to your trading. Do you want to play bullish when a stock is trading below the Kumo cloud? No. You want to stay bearish. You want to be in a bearish mindset. If the stock is trading above it, yes, you want to stay in a bullish mindset, which means looking for bull entries because you want to stay with the trend because the trend is your friend. Another way to use the Kumo cloud is as support and resistance for your entries and exits. This is very dynamic support. Now, factor in one major thing. The thickness of the cloud tells you how strong the support or the resistance is going to be. When you see something like this, where the Kumo cloud is extremely thin, these ranges, right, very thin, it's going to get very choppy. You know, you could go through it, you could go back up over it, through it again, back up over it. It's not giving you strong, dynamic support and resistance. But when you see a big portion of the cloud, thickness, right, you see that here, it's going to give you stronger support and stronger resistance. And often the lead 1 and lead 2, and reminder, the lead 1, lead 2 are the edges of the clouds, okay? Lead 1, lead 2 are the edges of the cloud. They're going to be very key, strong, dynamic support or resistance. And we'll just use this example here on this chart as of right now. Actually, you know, let's go to the 30-minute here because I noticed this as a good example recently. We broke through the cloud bearish, ended up being resistance over here. We didn't get exactly to it, but over here we had a bull breakout. Look what happened. It ended up being strong support. What happened? We came near it. Okay, price action started to follow it. Support, again, support, and now support again, support again. When it gets thin, when it's a very thin range, and you can see these little thin ranges here, and let's look for a couple more thin ranges over here, it can move through it rather quickly. But when the range is big, and I want to see if we can find a big one here, and I'm going to use this one right here, for example, you can see it's a big cloud right over here. Support, okay, we broke into it, you know, we hung out, we had a little bit of a bounce, and then we finally lost it. We didn't go through it rather quickly. We had some price action in here. The bigger, the more support or resistance it's going to be. The thinner, it really doesn't mean much. So at the end of the day, the Kumo cloud, I recommend using it on any time frame. If you're a scalp trader, really you're going to be, you know, watching it on the 5 and the 15, you know, you take it into account. I like it on the larger time frames, you know, 15 minutes and above. Of course, the larger the time frame, the more impactful because it takes more people to make it happen. But in this case, this is how I use it, guys. I just keep it very slightly in the background, very notable to understand where it is the price action coming up to it. Reminder, if you want to be very successful in this business and you want to keep things simple and you're looking at a chart and you're saying, should I trade this chart bearish or bullish? Very simple answer. Are you above the Kumo cloud? You should be looking for bullish entries. Are you below the Kumo cloud? You should be looking for bearish. Follow the trend. Don't fight it. It makes trading a lot easier. I hope you enjoyed this educational video. If you did, leave us a comment. Give us a thumbs up. Peace out, everybody.